Wow, this is crazy. Welcome back to the Explainer, everyone. Okay, let's dive into this immediately because the numbers we're looking at today are absolute monsters. Coca-Cola just dropped their Q1 2026 earnings, and headlines, they're screaming double-digit growth. But when you look at the stock market's reaction, there's this weird underlying hesitation. It's kind of like the market is staring at a gold mine and asking if it's made of fool's gold, you know? So, to help us cut through all this noise and figure out exactly what's going on, I've brought in our chief investment analyst.
Thanks for having me. To really understand what's happening with Coca-Cola right now, we have to look right past those flashy headlines. We need to examine the actual structural execution underneath. Today, we're going to unpack the three real causes hidden behind these stock price fluctuations. We'll look at the actual mechanics of their earnings beat, the macroeconomic headwinds pulling at their margins, and the widely divergent valuation models that are completely splitting the market right now.
Excellent! Here's our flight plan for today's explainer. 1. The Q1 earnings surprise. 2. The hidden business model. 3. A financial deep dive. 4. Their economic moat and risks. And finally, 5. 3 future stock scenarios. Let's get into it.
Right. Let's take a cold, rational look at the data.
Part 1. The Q1 earnings surprise. Oh my god, when I saw the initial print on this, I literally thought there was a typo. We're talking about a 130-year-old beverage company posting growth numbers that look way more like a Silicon Valley tech startup.
The performance is undeniably robust. If you look at the data here, you'll notice the global unit case volume grew by 3%. That directly drove a massive 12% jump in net revenues. CEO Henrik Braun noted that this strong start to the year reflects an unwavering focus on consumer proximity and managing complexity.
Wait a minute, doctor. Before you hit me with all these percentages, let's take a step back. What does Coca-Cola actually sell? Because it's not just cans of soda on a shelf, right? That's too complicated. Could you give a simple analogy? Which brings us to part 2, the hidden business model. Let me break this down for you, because misunderstanding their business model is actually the biggest mistake retail investors make. You need to think of Coca-Cola not as a beverage manufacturer, but as an intellectual property and syrup factory. The Coca-Cola Company strictly handles the concentrate production, the brand marketing, and the trademark management. The actual heavy lifting, manufacturing the finished beverage, bottling it, and driving the delivery trucks, that is entirely handled by independent bottling partners. For instance, in Korea, that partner is a subsidiary of LG Household and Healthcare. This asset-light model means Coca-Cola itself avoids massive capital expenditures on physical factories and fleets. Oh, gotcha. So what you just said basically means they own the secret recipe and the cool vibes while someone else pays for all the expensive trucks and factories. That is a brilliant way to protect their cash flow. Moving on to part 3, financial and fundamental deep dive.
Okay, so they have this incredibly efficient asset-light model. Show me the money. How did that model actually perform this quarter?
It's proven by the numbers. The top and bottom line growth is staggering for a mature megacap like this. As you track the GAAP versus non-GAAP columns, net revenues jumped 12% reported, or 10% organic. Operating income surged 19%, and earnings per share grew 18% to 91 cents. But here's the crucial part. This wasn't just driven by inflationary price hikes. While pricing and mix definitely played a role, unit case volume, which measures actual physical consumer demand, grew by 3%. Now, it is worth noting from the earnings call that the first quarter did have a half-point volume benefit from the leap year, but even adjusting for that anomaly, the fundamental demand creation is undeniably strong.
Really? A 19% jump in operating income? That is phenomenal. But how much of that actually trickles all the way down to their profitability margins?
A very significant amount. Their operating margin jumped to 35.0%, up from 32.9% in the prior year. If we evaluate the comparable non-GAAP operating margin, it was 34.5% versus 33.8%. This margin expansion is a direct, quantifiable result of management's ability to handle complexity and execute structural changes. Furthermore, the company expects even more margin expansion in the latter half of the year, assuming the pending sale of Coca-Cola Beverages Africa closes as planned. Wow, 35% operating margin on physical consumer goods. That is literally wild. But wait a minute, doctor. What does that have to do with our stock accounts? If they are making such good money and their margins are actively expanding, why is the stock price acting like it's stuck in the mud? Why is the market going wild with uncertainty when they're printing cash like this?
That is the exact right question to ask. The stock market is a forward discounting mechanism. It doesn't just blindly reward past performance, it prices in future risks. And right now, institutional investors are looking very closely at the composition of that volume growth and the broader macroeconomic environment surrounding it.
Let me break this down for you. Yes, the 3% growth slice is solid. It represents millions of additional unit cases sold. However, that massive 97% base volume must be maintained in an environment where consumers are increasingly under financial pressure. As CFO John Murphy clearly stated on the earnings call, while many consumers remain resilient, others are severely squeezed by persistent inflation and greater macroeconomic uncertainty. So the market is weighing this 3% growth against the potential for severe demand destruction if global economic conditions deteriorate. Additionally, there's a reported 6% negative currency impact on comparable EPS that directly drags down the ultimate cash return to U.S. shareholders.
Right. So what you just said basically means the market is terrified that inflation is going to finally tap out the consumer and a strong U.S. dollar is quietly eating into their international profits.
Let's go to part 4, economic moat and risks.
Okay, so if the macro environment is getting this scary, what protects this company? What is their irreplaceable weapon that stops competitors from just eating their lunch during a recession?
To understand their economic moat, we have to look at how they cultivate consumer loyalty and execute their brand strategy at a hyperlocal level. On the earnings call, CEO Enrique Braun detailed their consumer-centric approach, which he calls the 4 I's: insight, innovation, intimacy, and integrated execution. This is their moat. They leverage massive data and digital capabilities to be incredibly precise in how they serve consumers. It's an irreplaceable advantage because absolutely no other beverage company has the unmatched system reach to execute these 4 pillars globally across over 200 countries. Okay, insight, innovation, intimacy, integrated execution. Honestly, that sounds like great corporate jargon, but how does that actually sell more soda? Give me a concrete example.
Let's look at a real-world application. Look at the data regarding the success of Coca-Cola Zero Sugar in Europe. The insight was that at a certain time of day, consumers explicitly wanted to lower their caffeine intake, but they still craved the intimate, familiar flavor of the brands they love. The innovation was tweaking the formula to achieve that. The integrated execution was rolling it out seamlessly across the continent. As a result, in select European markets, approximately 60% of their zero sugar volume now comes from zero caffeine variants. That is the moat in action. They are creating more weekly plus drinkers by giving them exactly what they want, exactly when they want it. OMG, that's actually brilliant. They realize people want the taste at night without ruining their sleep, and boom, massive new revenue stream. But I have to play devil's advocate here. Even with $32 billion brands, they aren't invincible. What are the fatal weaknesses here? What could completely derail this train?
The 10Q filing outlines several severe risk factors that we must rationally consider. While their resilient portfolio of $32 billion brands provides stability, the fatal weaknesses lie heavily in external macro risks. Persistent global inflation increases their input costs while simultaneously squeezing consumer wallets. Furthermore, the earnings call explicitly cited volatility driven by the conflict in the Middle East as a direct pressure point. We also must factor in regulatory risks. This includes their ongoing tax dispute with the IRS, potential new indirect taxes on packaging, and rapidly shifting consumer preferences regarding artificial sweeteners.
Let's wrap it up with part 5, 3 future stock scenarios. Okay, we've seen the good, the bad, and the macro ugly. I need the bottom line for retail investors. What are the actual future scenarios for this stock? To project the future, we rely strictly on valuation models based on this source data. The Simply Wall Street narrative models show a massive divergence in how the market is viewing Coca-Cola right now. Depending on the exact assumptions you plug in for growth, margins, and discount rates, you get wildly different fair value estimates. We have a pessimistic bear case at $67.50, an optimistic bull case at $85.71, and the quantitative base case DCF model sitting all the way at $90.17. Let's break down the triggers for each of these scenarios. First, the bear case. In this pessimistic scenario, the fair value drops to $67.50, which would mathematically imply the stock is currently about 16% overvalued. The precondition or trigger for this scenario is a sustained high interest rate environment. Because Coca-Cola is a massive cash-generating enterprise, changes in interest rates directly and heavily impact the discount rates used in their cash flow models. If inflation remains sticky and rates stay elevated, the present value of their future earnings drops. However, even in this worst-case situation, Coca-Cola remains a highly attractive bond proxy investment strictly due to its unparalleled stability and historical dividend track record.
Right. So what you just said basically means if interest rates stay high, the stock price might really struggle to climb, but you're still getting paid a solid, safe dividend just to wait it out.
Correct. Now let's examine the bull case. In this optimistic scenario, the fair value target is $85.71, implying the current price is undervalued by about 8.5%. The triggers here are highly feasible based on the Q1 data. Successful expansion into high-value categories like value-added dairy and plant-based beverages, combined with surging consumer demand in emerging markets. If their digitization initiatives and sustainability efforts successfully insulate them from regulatory pressures and their asset-light operations continue to expand margins, as seen with the 35% operating margin this quarter, the stock will easily push toward these consensus targets.
Okay, so that's the sunny, optimistic view, but what does the raw, unfeeling math say is the most likely outcome?
The raw math leads us directly to the base case, generated by Simply Wall Street's two-stage discounted cash flow model. Coca-Cola's trailing 12 months of free cash flow is roughly $12.54 billion. The model projects this to grow to $15.66 billion by 2030. When you take these expected future cash flows and discount them back to today's dollars, the intrinsic value strictly calculates to $90.17 per share. Compared to recent trading prices in the $78 range, this quantitative approach signals that the stock is currently trading at a 13% discount. Despite all the macro noise we discussed, the core cash generation remains deeply undervalued by the current market.
And this illustrates exactly what we are seeing today. A classic quote from Benjamin Graham fits this situation perfectly. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Right now, the market is voting with its macro fears, but long-term, that massive $12.5 billion in cash flow is going to hit the weighing machine. Thank you for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our video production. Keep your heads cool, trust the data, but we want to know what you think. Are you comfortably waiting out the voting machine for those juicy dividends? Or is the macro environment just too scary to jump in right now? Let us know down in the comments, and we'll see you in the next deep dive.